So Jerome Powell crashing the market every time he speaks and stocks bleeding red since the start of the year, cliched advice to buy the dip hasn't always been easy. I mean, hell, even Graham Stephan had a hard time with that.
This time period, like 2022, I think if you're not being super aggressive, I think it's a mistake. I really do.
My worry though is, and I've said this before with other stocks, is when I look at Cisco from the .com bubble and you see Cisco taken, was it 12 years, 15 years? Or no, I think it's still trading below what it was at its peak in 2001. I mean, obviously that's not the case for every stock out there. But I do see that, and it worries me that there's nothing that says the valuations have to come back to where they were.
And he's right. Cisco is still down 42% since March of 2000, but today I'm going to show you once and for all why you just keep buying the damn dip in quality companies. And to prove this, let's use the Japanese stock market index, Nikkei, because it crashed hard back on March of 1991, with people still asking these questions, because 31 years later, you're basically at break even. But your returns improved dramatically if you had simply bought the Nikkei every single week. So, let's get some numbers from Yahoo Finance. This is the Nikkei's historic data, and we're going to go all the way back to January 1st of 1991 to match this chart. And let's set the frequency to weekly, which gives us all these nice price points. I've downloaded them on Excel, and since I only need these 3 columns, I'm going to delete the rest. And for fun, let's work with the averages of the opening and closing prices, and to make it easier for our American audience, convert them to dollars. Alright, so if you're still here with me, this is how the stock chart looks over the years. But let's see what happens when we decide to invest $100 into Nikkei every single week since January of 1991. Now on some weeks that $100 isn't going to even get you 1 share, but on others you're going to get almost 2 shares. But regardless how far that $100 stretches, you're accumulating shares, lots and lots of them. Because after 1 year you'll have 30.26 shares, after 5 years 185.94 shares, and after 20 years 1,027.97 shares. And after buying week in and week out, you're going to end up with more than 1,500 shares. And the number would be much higher if you reinvested the dividends, but I really didn't want to do all that calculation, so we're going to forget about that. So now we multiply the weekly share price with the total share counts to get our portfolio balance. And to compare, here's the total deposits. After all that, we get these 2 columns that reminds us that yes, buying the dip hurts like hell, and the dip might just keep dipping for weeks, months, or even years. For example, from April of 2000 to November of 2005, your portfolio just shows red. Imagine 291 weeks of losing money. And just when your portfolio turns green, welcome to the 2008 financial crisis. I mean, hell, if my portfolio is in the red for just a few days, I'm sweating bullets and a hot mess. But imagine being in the red for 5.5 years. That's longer than most of us have been investing. I'm sure a lot of us wouldn't be able to deal with the constant losses and sell out, calling investing a scam. But here's the reason why legendary investor Peter Lynch said this.
And the key organ in your body in the stock market is your stomach. It's not the brain.
Because for those who had strong stomachs and held on and kept buying Nikkei even when it was dipping, I have great news because you would have reached June 17th, 2013. Because on that day, the Nikkei is still down almost 50%, but it's the last red day of your portfolio, finishing down 3.66%. I mean, just look at all these nice green positive returns that's been going on for more than 9 years. And even better, compared to the Nikkei's 3% return in 31 years, your portfolio looks like this, an average weekly return of 49.17%, peaking all the way at 108.18% on September 13 of 2021. And yes, investing will have us go from this to this, happy and sad, back and forth and back and forth. I hope this video proved why you should never get scared out of investing, why you should always buy the damn dip, so your return can look like this instead of this. But anyway, thanks for watching, and I'll catch you guys all next time with more financial shenanigans.